What is up, everyone, and welcome to another episode of Personal Finance Boss. My name is Julian, and with me is Ali. Yes. So what is our topic for today?
Our topic today is target date funds, and that's at the request of a Miss Lauren who wanted some more information on target date retirement funds and how they would fit into 401ks in the States.
Okay.
But we have them in Canada also.
Yeah. So, to begin, what is a target date retirement fund or a target date fund?
It's target date fund, but It's mostly used in a retirement setting because these are funds that are usually only available for 401ks, RSPs, group savings plans. Okay. I don't think you can just go out there and buy a target date fund. It has to be in some sort of sheltered environment.
I'm not 100%.
I'm pretty sure about that from what I read in my research.
I will take your word for it.
But basically, target date funds, they're used for retirement. So, for example, if you're 20, let's say we're in 2020 right now for easy numbers, and you wanted to retire in 50 years, you would buy a 2070 target date fund.
Yeah, and what happens in the target date fund is initially it's heavily weighted on equities. Mm-hmm. So you can have different target date funds, from Vanguard, from Fidelity, from Manulife, whatever. And they'll say, okay, well, in this fund, we're going to be 90% equity and 10% bonds, and they're fixed income. And then as time progresses, we're going to slowly shift the equity into fixed income.
Yes.
So that the idea is when you retire, your portfolio becomes much less volatile. And the way bonds work is they pay you a coupon, every quarter, every month, every 2 months, and twice a year, every year, depending on the type of bond. And that's going to be simple income that you can then put in your pockets to pay for all your needs in retirement. Compared to equity, which has a significant capital gain portion, you will have to sell the stock to then be able to pay for your expenses. And that's a bit more complicated to do, and it's much more volatile. So one day you may have 1,000, next day you may have 800. You don't know much less what's going to happen in the stocks, and the stocks tend to move much faster than bonds. So essentially that's the idea.
Yeah, you're moving from a more aggressive more aggressive allocation to a very conservative one, basically a fully conservative one by the time your target fund reaches maturity.
85% bonds and 15% equities, or 90 and 10.
I'd say even more. I would say really heavily into fixed income, because by the end of that fund, you don't want to deal with market correction, anything of the sort. You really want to take that money and run. Yeah.
So there are different varieties of target date funds, just like you can have different mutual funds or different ETFs. So you can go into a Canadian one, you can go into American, you go into the world or emerging markets, stuff like that. And every fund that claims to do the same thing will have a different allocation. So just like any mutual fund, make sure to go and check what this target date fund has. Also, target date funds are what we call a fund of funds. Yeah. So it's a fund of mutual funds. So when we talk about all the fun we have paying fees in the mutual funds, well, you pay more fees in a target date fund because you may need to pay an extra 0.2%, 0.1%, whatever that percentage may be, so that the people that manage the target date fund can rebalance the portfolio adequately and rebalance between mutual funds and bonds, and rebalance between mutual funds if they get out of
the fees are also substantially higher, because in a fund of funds, if you have 5 funds, you're paying the proportion of each fee, and then the management fee of actually managing that fund.
Yeah, so you pay like an extra 1 or 2.1 or 0.2% over the initial fee of each individual mutual fund that you're investing
over the whole target period that your fund is there.
If mutual fund A and mutual fund B are in the target date fund, Fund A has a fee of 2% and Fund B has a fee of 2.5%, and you're 50-50 in each fund, the average fee is going to be 2.25, and then you add on let's say 2% to be in the target date fund. So you're looking at a 2.45% fee as opposed to a 2.25% fee, or opposed to a 0.06% fee in an ETF.
You just had to throw that in there, right? Because you loved ETF. Yes. But yeah, that's a huge spread. And it kind of, I wanted to touch on fund of funds. I actually wanted to do a podcast on fund of funds, but I think
would have been very fun.
That would have been fun-ish. But I think we could tie it in here.
Yeah.
And a lot of people say, fund of funds, even target date funds, it's kind of like a one-size-fits-all type of endeavor. What do you think about kind of the one size, just set it, leave it, forget it, go on with your day type of
Well, we're
investment?
talking about a target date fund here. A fund of fund could be many things, but in this particular case, a target date fund is designed for people who don't want to do anything when it comes to managing their money, apart from giving it to the target date fund. And there's nothing wrong with that. I mean, if you're busy with other things and you don't really care to look into this because they're professionals, they'll manage it properly for you, sure, that's not flawed logic, but you're going to pay for it, right? The less involvement you have on your end, the more you'll pay. So if you walk into a bank and you buy a mutual fund, you pay 2%. You go in a target date fund, you pay 2.3%, and you spend the time to open up a brokerage account, then you pay 0.4%, for example, or 0.06% for an ETF. So it all goes down to how much involvement you want to have. And then in a recession, when a mutual fund manager may be going more into cash and less into equities or stocks, then you'll have to do the same by hand in your online brokerage account, meaning selling ETFs and not purchasing any stocks and keeping it cash or buying a money market fund or something like that. So yes, there's going to be a much more active management portion, but at the same time, is it worth the extra 2% in fees? That only you can answer that question. So target date funds are designed for people who don't want to really be involved with managing their finances. And, for some that may be a good idea, because if you're one to be influenced by market trends, everyone's buying, I'm going to buy, and then you end up buying at a very high point, and then you sell at a very low point, and then you miss out on the rebound, then you might as well be paying 5-6% fees. You'd be doing better than buying on a high and selling on a low. So it's, some people are very against because they're even more expensive than mutual funds. But honestly, I think that they have a spot in the world just like mutual funds do, just like ETFs do, because they are towards a certain demographic. And I
wanted to mention also with this, fund of funds, I find, for example, in one of the part-time jobs I have, they have an RSP, a matching plan, but the only option within that with Manulife is the target date retirement funds. So a lot of times when you're working in companies and you have a group matching RRSP, the only option you could invest in is the fund of funds or the target date retirement fund. Okay. We did mention fees, for example, and 2% fees or 2.5% fees, they can really rack up over a multi-year period. They can really eat into your portfolio. But then again, with the group matching, if you decide, okay, I'm not going to invest in that plan because I don't want to pay the fees, remember, you're also going to be missing out on all those matching dollars that come with it. Exactly. So what I would suggest in that point, and Lauren actually asked me, what would you suggest with my group plan? Would you suggest putting money in there? I want to save money for retirement. Do you suggest maybe putting money in another account? My suggestion to that would be, and I think Julian has mentioned in the past too with stock options, is invest the max to get the max benefit you can from your matching option. Stick with that, and then if you want to invest further than that, go elsewhere, find a better option for you.
Yeah, don't keep investing in the plan even if
exactly. So never leave money and never leave dollars on the table, especially now because we've entirely moved away from the defined benefit pension plan. Stick with that if that's the only option. Take advantage of all those matching dollars. Take those all in because you're leaving money on the table if you don't. And then for your other investment needs, look elsewhere if you don't want to be paying those fees or want to take a different approach.
Yeah. And a few other downsides of this target date fund is, you have very little to no customization. The only customization you can do is to buy another fund, buy another target date
there's
fund.
There's no customization.
You can't play around with it. The next thing is, what if you retire earlier or what if you retire later? So you won't be at the optimal allocation based on them if you decide to retire sooner or later.
The biggest one really is the asset allocation, because the target date retirement fund at onset is completely aggressive.
Yeah.
So that's I think the biggest thing to consider.
And exactly. It's the asset allocation due to the date that you select, because target date funds are sold, 2050, 2055, 2060. So if you're planning on retiring at 2060, then you buy a target date fund for 2060. But if you end up retiring 10 years later, you're going to be invested in bonds for longer than you would have wanted to if you follow the logic of the target date fund.
Yes.
So that's one of the things. And if you retire sooner, you'll be more exposed to equities earlier on.
Yes. And yeah, you really need to, I think from an asset allocation perspective, you really need to keep in mind that when investing, you're really looking at the overall whole portfolio. And if retirement assets are a big part of your portfolio, you're already skewed highly aggressively in that. So if you're one of the people that are kind of a little bit more risk averse and you said, okay, this target date retirement fund, that's my aggressive investments, in your non-registered account or your play money account or your TFSA or your Roth account, make sure you're taking into consideration that in my retirement, I'm fully aggressive because I'm planning on retiring in 50 years or so.
Yeah.
Make sure you're taking that into account. And in your other accounts, you're reflecting your portfolio risk properly. Because if you load up on aggression there, then the entire portfolio is fully aggressive. And for some people and for some portfolio breakdowns, that's not the most ideal scenario.
Yeah.
So it's just something to kind of consider. And then the flexibility, because you have no flexibility.
Yeah. I mean, you could sell the fund and then move into another fund.
Yeah,
But
you could.
Apart from that, there's not much else that you can do.
No, you're really stuck. You're really stuck.
So, I mean, you have a whole page of notes. You must have.
I think we hit
some interesting things.
We hit most of them. If we want to get a little fancy with the terminology, I wrote down that most fund marketing materials show the allocation glide path, which is the shift from the aggressive assets all the way to the conservative.
Sounds so smooth.
It sounds so nice, doesn't it? It sounds really nice, I must say.
Yeah.
But yeah, I mean, for me personally, if this were the only option that I had in my group registered plan and it was being matched, I would take it because I don't want to leave dollars on the table.
Yeah.
But I think for me, because I know about the market and I want to try out different investments and I know which investments work. I like to pick a couple stocks, even though you're kind of a little bit against that. But
if you can, and it's fun. It's much more fun picking stocks. Nonetheless, doesn't mean you're going to beat the market.
No,
but it's fun.
So I think I wouldn't necessarily opt for. I'm not going to go to Manulife and be like, hey, I got $10,000 or $5,000. I want to buy your 2055 target date retirement fund. I'm super psyched about buying it.
Yeah.
I don't think I'm on that boat.
It's something you do and you close your eyes and then you wake up at 2055 and then you'll have some income.
Exactly, you know?
And also another way to lower the fees, which I didn't mention earlier, is that just like you can have different styles of mutual funds, meaning active or passive, you can also have different styles of targeted funds, active or passive as well. Active funds is where the manager would actively try to buy and sell stocks to beat the market, and passive is where they just buy the benchmark or some in some index, some
passive,
some proxy of the benchmark, and they just try to give you the return of the market. So those funds are cheaper than the actively managed funds.
And then the other thing is, if you don't know when you're going to retire, I would suggest maybe in that case, even if you're planning on putting in, if you want to choose different funds, different target date funds, maybe straddle some of your funds so you have some of them expiring at different times, because you don't want to retire 10 years early.
So you can buy like a 2040, a 2045, and a 2050.
Exactly.
Yeah.
So you're really straddling and you're getting the exposure of each thing. And also some people with kind of higher asset bases where the retirement assets maybe aren't the bulk of their assets, they might say, this I can afford to go full equity on, and this stuff I'm going to manage a little bit more conservatively because I this is the kind of stuff I want to manage. Those ones, because it's in a group plan, I don't really have a lot of authority over. We're going to let those ride with the more aggressive strategy.
Yeah.
So you have that option as well. But it does limit you very highly from a flexibility point of view, especially considering we're also in a 401k plan where withdrawals are taxed.
Yeah.
So there's also that to consider as well.
Yeah. Yeah, so there's a lot to consider, but essentially, if you want an all-inclusive, one-stop-fit-all type thing, one-stop shop, one-size-fits-all there, sort of financial instrument, this is what you would need if you're of the opinion that you want to be in bonds later on in life because they're less volatile and less risky than stocks per se. Then yes, I would recommend target date funds. Otherwise, I don't think it's worth the premium.
Yeah.
That you pay because you can easily just
easily construct one on your own.
Yeah.
And I have $5,000. I'm going to do $1,250 for 4 of them. I'm going to do $1,250 Canadian, $1,250 international, $1,250 NASDAQ, and $1,250 Dow.
and then 12, 15 bonds.
Yeah.
And then shift and increase your bond holdings over time. And, there's so many things that you can do. And yes, you'll have to do it on your own, but
the fees you're going to save are huge.
I know that in our course we talked about the impact of fees with graphs and did we do a podcast on that?
I think we've mentioned it in segments
but we should do one with
there.
numbers so people really understand how badly the fees can impact you.
Yeah.
I mean, it's going to be it's going to be like a 5-minute podcast, but I think that we should do one or include it with something to just really illustrate our point even further.
Okay.
Even though we illustrate it every other episode.
That sounds good.
Yeah. Okay, guys. Well, I'm pretty much out of things to say about target date funds. Okay, great. So then I hope you learned something in this episode on target date funds. As usual, you can reach us at personalfinanceboss@gmail.com. You can also
reach us on our Instagram page at Personal Finance Boss or on our Facebook page at Personal Finance Boss. As well, you can check us out on our course on Udemy, the Personal Finance Toolkit for Beginners, where we talk about all the common investments, how to go about them, and how to break down your very own portfolio as well.
Yeah, and if you guys are enjoying the podcast, you can follow us on SoundCloud or like our Facebook page to give us support. And if there are any topics, just like Lauren, that you want us to cover, don't be shy. Reach out to us on Facebook or by email, and we will see what we can do to help you guys. Take care.
Thanks.